Here's one of those 81 PD arrays. The market trades up and starts to roll over. What time of day it's at? It's 12:42. So what are we approaching? We're fastly approaching what? That 1 o'clock hour, and the news is going to be released at 1 minute after 1. Okay, so basically it's 1 o'clock. So 1 o'clock, the bond auction number is going to be released to the marketplace, and then everybody does whatever they're going to do based on that. Okay, so what's actually happening is the market's already starting to run lower. This candlestick traded up into this gap. Now, if this was a PD array that I wanted to trade on, that would be my entry. But because I'm trading ahead of, no, this is the stuff that you write down. What do I do if I am not going to trade the fair value gap? What am I looking for ahead of a news chart? Because sometimes you'll see me take a trade before the news or before the opening bell. If I know at 1 o'clock, that's when the news is going to hit for the bond auction. Okay, we already rounded over here and we had a fair value gap there. The bodies are respecting it and we started to displace lower. So just with this alone, looking at the chart like that, okay, if it's just looking like that, in your rudimentary understanding of what I'm teaching, you already know the likelihood that it's probably going to explore below that low. Why? Because that's where liquidity is. And it's been going down all day. And this is the time it stopped and came all the way back up here and moved lower. So what is it? Remember what it's gravitating towards down there, okay? But now you have this short-term low here. By itself, that's a reason to be short. You have two factors. You have that new day opening gap. Then you have this low here where there's very short-term minor sell-side liquidity, okay? So there's sell stops below there. Don't be worried or consumed about the fact that these highs are relatively equal. Don't let that bother you. Why? Because the market's moving lower and it's pulling to this. And even if it doesn't trade there during the day session, because this is the day session low here, during the 7 o'clock to this point, this is the lowest it traded to at that time. So there's going to be stops below that for anyone that try to chase this going higher. These relative equal highs, they can stay in play. They don't need to be upset. They don't need to do anything. The market's going to stay heavy and keep working lower. How do you know that, ICT? Experience. The fact that this is still likely to happen. And think, what's over here in the London session? So we have this low, and this. So what is that? That's three things. That's heavy factors on wanting to see price draw to it. It's liquidity, and the market is operating on a narrative that it's going to drop to reach into that liquidity. Because if they're going to spend all this time above these relative equal highs during the 7 o'clock hour and 8 o'clock hour, and then they Judas swing into the 9 o'clock, well, this is all being held up there, tripping people up, chopping people up, grinding them all up, and then finally it breaks. At 1 o'clock today, we have a bond auction. That's the only point of interest that I have on the final calendar, and it's a medium impact driver. It's not high impact, but it's medium impact. But now, anyway, we're going to go back into this area right here. I got to zoom in on it. All right, so I know that this is the time when the market should start running because that's when the bond auction numbers come out. Okay, we're up here. I know I have a real strong likelihood it's going to at least take this out and maybe run below here going into that 1 o'clock news release. Well, here's the 1 o'clock, and then the market drops. Here, what I was looking at is I want to see, does it do this? Does it run up into this fair value gap there? There's your fair value gap. And what is it doing there? Does it at least touch the consequent encroachment or midpoint of that gap? Look closely. No, it doesn't. It gets real close to it, but it doesn't. It just falls short of it. The fact that it goes up there and doesn't touch it and then closes here, I know that that right there is a bearish order block. I can trade after the next candles come up and bump in the bottom of it. I'll trade short there. All it has to do is move away from it and then come back up into that. I can trust this candle not being overtaken. What's the next candle do? Goes up to it, but doesn't touch this line, and it doesn't even breach the candle's high. Now, if it would have traded up and touched that midpoint and then did that, I would not have taken that trade. I would have waited for another attempt to get in there and work just a little bit above the consequent encroachment, and then I would try to go short in this upper part there. That's what I would have done differently. But because it didn't and couldn't even touch the consequent encroachment, these are PD arrays. And yes, they're used for very specific and static levels to enter and exit on. But I also use these same price points as a means of measuring strength and weakness. If this candlestick can't even touch that, but gets close to it, it's signaling. It's a signature. That's an algorithmic signature for someone that knows what they're looking for. That tells me that when this candle closes, all I need to do is see it move away and come back up and touch the bottom of that, and that's a bearish order block. Now, with that logic, I can be short and take a partial below here, or if I know that I can trust that it's going to go down below the London lows, then I'll put a limit order below that. The fact that we traded up here and we didn't touch the consequent encroachment of this, I like to see if there's two fair value gaps, because we have here and we have here. You have to at least anticipate that it may go up into that higher one. But if it fails at the lower one's consequent encroachment and there's a news driver coming, I have no problem, no fear of absolutely none of getting into the trade. So I wanted to see this stay open. Okay. I wanted to see it fail to get to that midpoint of the lower one because it failed there. Okay, wonderful. I'm not worried about it. But go back to what I was saying. If it would have touched the consequent encroachment and this candle, I would have anticipated trading up into the higher part of this. And then my stop loss would have had to be above the midpoint of this consequent encroachment. But anyway, it drops down and then we have an immediate rebalance. Okay, so we have the market trading down here. We have a big down closed candle. The market trades back up. Boom, bumps into it here. Immediate rebalance. And then I get a little bit of heat here, but that does not take me underwater because the larger trade entry is here. So 6 contracts at the higher price if I'm short. The secondary affords me, when I'm only doing 4 contracts, it affords me to trade above that entry. It's forgiving because it could do what? It can revisit this fair value gap. It can trade inside that, but I don't want to see it do that. So I had to have a little bit of heat there, but it doesn't fill it. It just goes up to that level there. And what is it doing there? Is it touching the consequent encroachment before it makes the swing high here? Nope. So what does that tell me? It signals to me, just sit back and relax. Don't do anything. Just relax. Move your stop to your first entry, minus 2 ticks, and just relax. And now we go into 1 o'clock. Look what happens at 1 o'clock. They pump it and then dump it. Small little fair value gap right there. When the narrative's in play and it's going to go lower, or your analysis is assuming that it will go lower, you're looking at how the market is treated at every SIBI, sell side imbalance, buy side inefficiency, or a fair value gap that has a down close. So we have a little bit of an overshoot there. That's called a mohawk. It doesn't change anything. Did it take out this high? No. All it does is it went outside the boundaries just a little bit, and the next one gives you peace of mind because what is it doing? It's stopping right at the high of the fair value gap. But the market trades aggressively after 1 o'clock, after we have a retracement. So here we have model 2022. Here we have optimal trade entry, focusing on the time of day and anticipating the delivery of price based on factors that call price to it. New day opening gaps, new week opening gaps, relative equal highs, relative equal lows. And then below that, in terms of importance, you have inefficiencies. Inefficiencies are subordinate and less important than relative equal highs, relative equal lows, or new day or new week opening gaps because their influence over price. The algorithm will refer and prefer more importance and significance placed around them. Gaps, when they're actual, like new week open and new day opening gap, that is absolutely going to be much more significant because there's a lack of trades there. Inefficiencies, I'll say this much. You have one side of the delivery offered to it, meaning that, for instance, let's go back to this one here. This sell side imbalance, buy side inefficiency has sell side delivery. Okay, sell side delivery is always one-sidedness moving lower. Sell side liquidity is what's resting below that low. The London low, or relative equal lows that this line is here, that's these over here. That is sell side on the daily range. That's the lowest it's moved for the day, overnight, London. So it's going to want to try to gravitate to that too. That is real orders. That's not inefficiency. There's real pending orders down there. That is the lifeblood of the marketplace. Real buy stops, real sell stops. That is the heartbeat of what makes these markets go up and down. In between that, okay, you have inefficiencies. Inefficiencies have one pass through. So they have delivery. In this case, we have sell side delivery, but what is it lacking? Buy side. If I'm bearish, I don't want to see buy side offered because what that's telling me is I don't want to see it trade in the upper half of this. I don't want to see that at all. In fact, I'm enamored when I see it not even touch consequent encroachment. The fact that we don't touch that consequent encroachment or midpoint Man, that tells you what? It's really heavy.